Hello, everybody. So today is Sunday, the 12th of March, and everyone would have seen that on Friday, the 10th, the US bank Silicon Valley Bank was basically, well, it was shut down. It's no longer viable. It's been shut down by the US regulators, and today is 2 days later, and you would have seen lots of comment or in social media, on the press. I'm going to quote from the Sunday Times in a bit today, today's paper, the Sunday Times. So there's been lots of comments about the failure of Silicon Valley Bank and what lessons to learn. And I was asked by one or two people in the markets to comment on it myself. Which I'm going to do now in this short video. First of all, I will just say, almost as a kind of disclaimer, that we've only just recently noted where the bank was getting difficulties, and it's only just now, a couple of days ago, actually been declared bust or no longer viable. And so things may come out in the wash. There could be new information that comes out that might cause us to change our opinions or our views, or there could be other lessons learned. So at an early stage, in response to this request to what do you think, Moorad, of the failure, I'm going to give you one or two opinions, but I'm holding up a disclaimer to say that I may change my mind. We could find new information, or it could be that I've got the wrong end of the stick. But at this stage, based on everything I've read about it so far, I don't think I have. So let's begin. Silicon Valley Bank, here in 2023, after years and years of Basel III regulation or international guidance on minimum liquidity and market risk management standards and capital standards, we still have a bank going bust for what I consider to be reasonably old-fashioned reasons. Now, let me begin by saying, by first quoting my old boss from my Royal Bank of Scotland days, when I spent 4 years at Group Treasury in Royal Bank of Scotland. My old boss there, John Cummins, he was always saying, the balance sheet is everything. The balance sheet is everything, and never a truer statement said. The balance sheet is everything. And it appears to me that this is a failure of managing the balance sheet. If anything, then therefore it's a failure of the bank's liability committee. It's ALCO. So what have we heard so far? It turns out that they were holding a large portfolio of mortgage-backed securities, and the rise in interest rates undertaken by the US Federal Reserve over the last year has resulted in the value of that bond portfolio tanking, which has hit them in their capital. Now, there's accounting issues here, hold to maturity, or what used to be called available for sale. Let's park that for a minute. So the loss in value of this portfolio that came about through the rise in rates has hit their capital base. That appears to have led to a knock-on effect from depositors seeing the drop in the share price and also seeing the capital call. They were trying to find a fairly large chunk of capital, which didn't succeed, and so there was an outflow of funds and a good old-fashioned bank run, and then we had the bank being shut down by the regulators. So they were running a large amount of interest rate risk, and it appears that they didn't have too much management around that interest rate risk. Now, I've seen elsewhere that hedging interest rate risk is not for mortgage-backed securities, the portfolio bonds they were holding, is not as straightforward as hedging, say, fixed coupon vanilla securities like US Treasuries. That's true, but managing interest rate risk is a time-honored art. It's something that banks have been doing for some years now, let's say at least since the early 70s, after the breakdown of Bretton Woods. And so getting a grasp on managing interest rate risk when you run a large interest rate risk sensitive portfolio seems to me fairly basic logic. It seems to be something that a bank should always be doing. One doesn't need regulation to tell one to do this. I mean, BCBS 368, which is the Basel Committee's guidance on interest rate risk in the banking book, is published from 2016, hasn't been fully implemented in the US as far as I'm aware, and not for systemically unimportant banks. But of course, what were banks doing in the 70s and 80s and 90s? I was at Horgavet Securities in the early 90s and through to the mid 90s, and we used a simple metric, DV01, dollar value 01 or 01, which is appropriate here because Silicon Valley Bank reports in US dollars. What were they doing to manage their interest rate risk? It's not something that one necessarily needs a regulator to tell one to do. It's a time-honored art. So they didn't seem to have a handle on managing the large interest rate risk exposure they were running. But perhaps perhaps they thought they didn't need to because interest rates had been stable for a very long time. But here's something that all bankers have known for the last 400 or 500 years, and that's that interest rates go up as well as down, and they move as well as stay still. Interest rate volatility or interest rate stability is something that we should accept. We should always be ready for a movement in interest rates, whether it's up or down. I was about to say sideways. I don't suppose they move sideways, but up or down. They didn't appear to have got anywhere near managing the interest rate risk that they were running on a portfolio. So DV01, good old-fashioned metrics, doesn't need regulation to tell you what to do. It's simple old-fashioned banking risk management, didn't seem to be in place. Now, the impact of the rate rises, which brings to mind the effect on the savings and loan industry in the early 80s, when the Federal Reserve again embarked on a large rate rise cycle, and that affected the business models of a number of savings and loan institutions, which were found to be unviable, again, because they weren't anticipating a rise in rates. So there's a good analogy there, which I've seen elsewhere on social media, good analogy with the savings and loan debacle of the early 80s. Interest rates go up, one isn't ready for it, one hasn't hedged balance sheet for changes in market factors, and so one suffers the consequences. Now this, and again, it doesn't need BCBS 368 to be implemented by the US Federal Reserve or the US regulatory agencies for a bank to know to do the right thing. But once this impact got known, there was a knock-on effect. Again, it's a reputational or a contagion effect when people think banking is all confidence. If your depositors think you're no longer viable, they're going to be taking their deposits out. But it would appear that their liquidity risk wasn't on top of either. Now, someone has dug up a quote from one of the bank's disclosures. One of my students, one of our students on the BTRM, on the current cohort, has dug up one of the disclosures from Silicon Valley Bank, and I'm going to quote it. As a banking organization, our liquidity is subject to supervision by our banking regulators. Because we are a Category 4 organization with less than $250 billion in average total consolidated assets, less than $50 billion in average weighted short-term wholesale funding, and less than $75 billion in cross-jurisdictional activity, we currently are not subject to the Federal Reserve's LCR, liquidity coverage ratio, or NSFR requirements, either on a full or reduced basis. Now, does that mean, therefore, that the institution can absolve itself of the need to manage liquidity risk? No. What did banks do before we had LCR, which only dates from 2010? What did banks do to manage liquidity risk? Again, the last 500 years. What was I doing when I was the junior, first, before I was running the book at Horgovet Securities, being told we always run a liquidity book of at least X% minimum of the total balance sheet? So whether or not one is obliged to follow LCR minimum liquidity reserve requirements, good banking practice would dictate that they had what they considered to be a reasonable reserve of liquid assets, genuine liquid credit risk-free assets, to cover a bank run, which they would have stress tested for, saying that one would stress test for market risk. So that seems also to have been missing. Now, I've read today that the institution didn't have a chief risk officer the last 8 months. If that's correct, the mind boggles as to how one is happy to run a portfolio or a balance sheet of significant interest rate risk and potentially significant liquidity risk without a CRO being in place. I still don't think that's any kind of excuse. The Asset Liability Committee in any bank is comprised of more than the CRO, all the C-suite, the heads of the business lines. So I'm not sure what the ALCO was doing running this balance sheet risk without a CRO. But there's that. So what does this all boil down to? Well, lack of good old-fashioned liability management practice, absence of a CRO, absence of what I think they probably weren't doing, reverse stress testing. One of my colleagues on the BTRM faculty does a whole standalone lecture on, Professor Dr. Michael Eichhorn, does a whole standalone lecture on reverse stress testing. I guess they weren't doing that either. And so I conclude at this point that the failure of Silicon Valley Bank was a failure of the institution's Asset Liability Committee, in not realizing that interest rates can go up as well as down, not realizing that one needs to run a minimum liquid asset book, irrespective of any reporting requirement or obligation from the regulator. So that's what it appears to be to me today. Now, I read in the papers, or in fact, I saw a Bank of England announcement. Silicon Valley Bank had operations outside of the US. They had one in the UK, not a large institution, but it had a deposit base comprised of, again, fintech and crypto type deposit customers. That's also just been put into administration by the Bank of England, absent any further information. It's a very short press notice the Bank of England have put out. Now, that made me think, maybe for all regulators, when it's a foreign institution, a subsidiary, perhaps there's a case for making the subsidiary standalone, self-sufficient for capital and liquidity, so that if the parent goes bust, the overseas operation isn't impacted. I remember reading with interest some years ago that Santander UK had a higher credit rating than the Santander home entity, which is of course headquartered in Spain. And I was chatting to someone at the rating agencies, I think it was Moody's, but and they were explaining that, well, yes, when you look at the Santander UK as a standalone entity, its capital and liquidity and other balance sheet safety factors are so considerable that even on a standalone basis, it warrants a higher rating. Perhaps there's a case for regulation in any jurisdiction to have the overseas subsidiaries standalone, self-sufficient. So when the parent goes bust, irrespective of the parent regulator shutting down the institution, the UK institution can continue, and so without any detriment to depositors' funds. So we'll stop there, more or less. A failure of good old-fashioned ALM discipline. And what is the first thing that any bank, any regulated banking entity should be looking after? It's demonstrating that it can manage with safety its customers' deposit base. One doesn't need the same sort of regulation to lend money. Accepting deposits is what banking regulation is all about. So if you are accepting deposits, one needs to be a safe store of value, and indeed safe store, full stop. Not so much a value, that's inflation impacted. Safe store of your customers' deposits. And that is the number one objective of a bank. Elsewhere, you'll read lots of noise about, holding higher yielding assets because US treasuries were yielding little until they started raising rates. So then maybe there's a P&L incentive. Whatever the noise around this, accounting treatment, HTM, AFS, mark to market, DV01, higher P&L versus lower P&L. At the end of the day, your number one requirement as a bank manager is to safeguard your customers' deposits. That's what banks are supposed to do. And everything else around it should be in support of that. So a failure of bank principles appears to be, or failure of managing two traditional bank principles appears to be at fault here, appears to be the driver here. Now, you might think I could recommend a text on this, and I could indeed, but it's been written about before. In the first edition of Principles of Banking, I quote two gentlemen from the Federal Reserve Bank of Minneapolis who wrote about the liquidity crisis from the savings and loan debacle of the early 80s. The name was John Boyd and Mark Gertler. That was published in 1994. So I guess the ALCO of SVB, of Silicon Valley Bank, could have maybe read that paper. We could go back earlier to this book here. And this was published in 1890. The Country Banker, His Clients, Cares and Work, by an English gentleman called George Ray. Now, I don't expect that the ALCO of Silicon Valley Bank would be familiar with this text, but if they had been, they'd have realized that adhering to its principles would have not got them into the situation that they find themselves in now. So there's plenty of material one can read going back from the past that if one adheres to as an ALCO member, an Asset Liability Committee member at any bank, should mean that one should be able to avoid any negative impact once very simple things happen, like interest rates going up. Right, there we are then. I'm going to leave you with that, just to say that new information is coming out all the time on this, so I reserve the right to change my opinion if I become once I become aware of information that might cause me to change my opinion. But that's my views on it so far, and I hope you found this video interesting, or at least of some value. But I reserve the right to come back and say, oh no, I've changed my mind, if indeed I find new information. But at the time being, I would say always manage to traditional bank principles, and maybe there's a case for having genuine ring-fenced overseas entities so that a parent going bust doesn't impact overseas operations. That's cold comfort to depositors of the home entity, of course, in the US, who may be looking at losing their deposit base where it's not covered by a government guarantee scheme. But unfortunately, that's another lesson learned for us, hopefully, that we'll all learn from going forward. Thank you very much, and have a good day. Bye-bye.